All right. Well, we'll go ahead and get started here as some more might be attending over the next couple minutes. But for those of you that joined on time or shortly thereafter, grateful to have you today. So today in our monthly webinar, we're going to be talking about building passive income through real estate investments. I can see several of you on this webinar, already have some, or maybe be people I've already spoken to. So hopefully will help you better understand the process in the syndication world, maybe a couple other options available to you, and to those that have never done it before, give you some insights as to what your options really are and who they're most, in my opinion, most applicable to. So, ultimately, we're speaking specifically of passive income in real estate. So there are definitely going to be types of investments that you're maybe familiar with, maybe you've done on your own, that might not be passive, i.e., direct real estate ownership, either through single family rentals, the most common route, or direct partnerships where you are active in the deal into larger deals. But we will hit on more of those, what I consider passive from an actual activity standpoint, not necessarily the IRS definition of what passive income is. But for those of you that are joining that are new to the Blackgate Network, I'm Evan Pulaski, the Director of Capital Raising and Investor Relations here at Blackgate, and put on these monthly webinars with topics that I feel are important to me as a limited partner myself, as well as hopefully to you guys as well, to help you broaden your understanding of what's out there. So before we dive too far in the three areas that we're really hitting on today, I want to be clear that this is all educational in nature. As I mentioned before, this is not specific investment advice. I am not your investment advisor. I'm hoping to just really treat this as more informational and different things that I look at personally as both an LP and an active investor, both in real estate and more broadly, and really helping to just share some information to help guide you on your journey as you're venturing into new opportunities. But when we are talking about specifically, ways to build our wealth, that's why we're all here, both the passive income and ultimately the wealth generation that can be derived through any investments, but specifically real estate. There's really three main buckets as I view them. There are probably some sub buckets that I might touch on within these groups, but ultimately we're talking about REITs, crowdfunding, and then direct syndication investment or LP, limited partner type investment. And really what do each of those look like? What are the pros and cons of each? And specifically as we're diving further into those, some of the red flags, due diligence items that I start with when I'm assessing these types of investments. So let's start with the most, I'm going to use the term broad, real estate investment trusts, commonly known as REITs, and specifically the publicly traded REITs. For many people, this is going to be the easiest way to get some real estate exposure. They are available on any platform. I have a small Robinhood account, your Schwab account, anywhere where you can buy and sell stocks. A publicly traded REIT is available. So what are these? Specifically REITs, I always like to hit on this. I know it's getting a little bit into the weeds, is a tax structure. So many people will use the term REIT as an investment vehicle. Most of the time, that means a publicly traded REIT, a real estate investment trust. But at the end of the day, a REIT is truly a tax structure. So just be cautious if you're going to be using that terminology. Somebody might take it a little more technically or use it a little more broadly, and there seems to be some colloquialisms with that in terms of what people are meaning. But when we're looking at that, the biggest piece to a REIT is that it is highly liquid. So this is something that, like I said, I could be sitting here live on this webinar and open up a Robinhood account and buy, shares of my former employer right out of college, Pico, Phillips Edison and Company, which is a grocery anchored shopping center REIT. Um, they're but you can do that with apartments, office, multi, kind of diversified asset classes. But ultimately, a REIT is going to be a real estate investment through the publicly traded market. You know, so not only are they highly liquid, but you can buy them. I have in here typically $100 to $500. In reality, you can buy partial shares of many stocks anymore for far less than that. $5, and you could open a Robinhood account and buy a partial share of a REIT. The beyond the low entry cost, the highly liquid nature of them, there is a certain level of diligence that a company has to go through just to be underwritten to be a publicly traded company. So again, I'm speaking more in the publicly traded REIT space, uh, but it does create a bit more of the professional management in that large institutional investors tend to be the largest holders of any stock. And so there is, definitely that credibility that comes with high levels of due diligence and public scrutiny to that, as well as more directly when we're talking real estate investing. You're dealing with a company where you own a stock, just like I own, Apple stock or Procter and Gamble stock through probably some mutual funds and ETFs that I own. I'm not making an iPhone. I'm not producing Tide detergent and marketing it for sale to Target to then sell to the end consumer. You step away and it's truly passive outside of the diligence and monitoring of the actual investment itself. Another big benefit of REITs are due to their scale and just general nature. They are typically going to be highly diversified. Like I said, you can buy a diversified REIT that might have multiple asset classes under one company's ownership, but oftentimes you're buying a specific sector. Again, the example I'll use is Phillips Edison and Company, the company I started my career in out of college, that owns grocery anchored shopping centers. So they are fully retail, with grocer anchors in a vast majority of their centers and are publicly traded. And by buying into that share class, I'm not just buying one of their assets, I am buying their entire portfolio, which I have lost count of how many assets that is, but it's basically a nationwide portfolio of grocery anchored shopping centers. Alternatively, when you're looking at REITs, the most famous, or one of the more famous ones, is the Empire State Building. At least it was. I haven't checked recently, but it was a publicly traded REIT that owns the Empire State Building in New York City. And in that instance, you are getting a share of one specific asset. It's a standalone company in and of itself that you could own. What are some of the downsides of REITs? Well, as you can see from the graph on the right, they tend to be highly volatile and relatively highly correlated to the broader stock market. So if you're looking to insert real estate into your portfolio for diversification purposes, and you're trying to balance out a heavy public equities type portfolio, you will achieve a little bit, but not as much as other options within the real estate space to create that diversification. They tend to perform reasonably close to the stock market in terms of long-term average annual returns. They tend to be buy and hold type assets within that property. And then the other one is, especially in the publicly traded space, you're receiving dividend income, which is typically taxed as an ordinary income, but speak to your tax advisors first. But there's not the quote unquote typical tax benefits that you're going to get when you move into more of a private type offering in the real estate space. One thing I forgot to mention is the Q&A panel is open. So if you click at the bottom of your screen to ask, to go to Q&A, you can type in any of your questions throughout this and I'll address them as they are arising. And if anything comes up during that doesn't really fit in directly, we'll certainly cover that at the back end. So if we're not going to do REITs, what's the next option? And this is kind of the crowdfunding space. So this I sort of put this in between, as it says on the right, between the publicly traded REITs and the direct syndications. So you're typically going through a platform that different operators are pushing their deals out onto. A lot of times you can get smaller investment minimums. Uh, they are often targeting slightly higher returns than the publicly traded REITs have historically earned. And you're starting to get a little more visibility into deal specifics. So with the REITs, you're kind of buying, if you're going to pick individual REIT stocks versus an ETF, but you're going to be buying an industry and then a portfolio of assets within that industry, typically. Uh, the crowdfunding place can kind of blend sort of the private equity fund direct into deal level investments. Um, but you are ultimately getting uh, you know, kind of a blend of both slightly higher returns, ideally, lower investment minimums, typically, but longer hold periods. So moving from REITs to crowdfunding, the biggest piece, the biggest differentiator tends to be you are moving into an illiquid investment. You're now controlled by the sponsor of that deal and how long they intend to hold that asset. Uh, so there are additional, or I'll add this, additionally on the diligence side, where generally speaking, to be a publicly traded company, you are, you know, you're put under a microscope on a regular basis, both through SEC reporting, analyst coverage, but even into that initial IPO, assuming you're coming in at that stage, the major investment banks who live in these spaces are doing all of their underwriting. Not to say there aren't some red flags with IPOs in the past, a la WeWork, but by and large, there is a level of comfort in knowing that you're investing in a group that has a long seasoned track record of success at the REIT level, the publicly traded REIT level, where depending on the platform you're using, almost anybody can get onto the crowdfunding sources or platforms. Some of those platforms will do more diligence and have kind of higher thresholds for a sponsor to place their deals. Others are just, put it out there and we'll market it for you and collect our fee. Um, so again, it kind of fits the sweet spot, higher minimums than REITs, illiquid relative to REITs, but you know, but a little more access and broader access, especially if you're trying to get into deal specific type options. So moving from here, you get into much more of the direct real estate syndication, which again, seeing the list of attendees right now, many of you are familiar with, some may or may not be, as I don't recognize those names. Uh, but what is a syndication? A syndication is basically you're going into a direct investment typically into a deal. The colloquial definition is when people are syndicating, real estate sponsors are syndicating deals, they are bringing a specific deal out to their investor base to allow them to invest in, versus a fund, which again, technically, definitionally is a syndication, but a fund is going to be more multi-asset, um, own multiple assets at once under one investment structure. But ultimately, a syndication is going to be pooling investment capital to buy a, a a real estate deal, typically a larger deal than one would typically buy on their own, and it creates the sponsor finds the deal, runs the deal, manages the day to day, and ultimately just reports back to the investor. However, the investor does get a lot of that direct real estate ownership uh, benefits, I guess. They're not going to have the answering tenant calls, the property management level type of assets. They will typically almost exclusively not be signing on the loan and taking on that personal liability of guaranteeing a loan. But they will get, if you attended my webinar last month, the pass-through depreciation, a share of the cash flow, and ultimately a share of the profit as the deals are selling, based on how the assets are structured. So these can be structured in an LLC, a limited partnership, some type of limited liability type legal structure. where you are ultimately doing your diligence on the sponsor and maybe some diligence on the deal, and then signing a subscription agreement, signing some legal documents, and funding the investment is about the extent of your involvement from that point. Um, the biggest reason people like syndications is, again, the tax benefits tend to be a little bit higher historically, and we've all probably been in some deals that haven't gone exactly as planned. Uh, but historically, they are typically seeing more of the higher overall returns over the long term, market cycle dependent, than both REITs um, and even some of the crowdfunding sources. And they give you that bonus depreciation that's passed through. Uh, Now, some of the trade-offs are obviously the investment minimum. I will say the very typical syndication that I have seen focus primarily on individual investors is going to be a $50,000 minimum. There are some that are lower than that. There are certainly some that I have spoken to sponsors just to find out that it's $250,000 minimum, which is a little bit too rich for my blood. So that will vary, but typically in that 50, maybe $100,000 mark is the most common minimum investment. They are going to be illiquid to the same way crowdfunding is, depending on the business plan, the asset class, the type of deal it is. You commonly see, I'd say, 5 type year hold, 3 to 7 years is pretty consistent. Again, depending on each group, you have to be accredited. Oftentimes, there are ways to, if you do not qualify under SEC rules as an accredited investor, there are ways to or there are options where you could invest as a sophisticated investor, but a lot of the deals you're going to find are probably only going to be open to accredited investors. But then and then you have that uh, direct relationship because these are not through a platform. Typically, you are going to be interacting directly with someone at that syndication who is a member of the management team day in and day out to be able to address questions, understand the deal structure, any questions that you have. So, why are these great deals in my opinion? Or who are these ideally positioned for? People who are looking to place bigger checks. And when I say bigger, again, 50 to $100,000 checks versus $10 checks in REITs or $10,000 checks in the crowdfunding sources. People who really want that tax benefit and are willing to let the deal kind of be tied up. Oftentimes, that's the busy professional. But just to recap, kind of side by side, you've got your REITs, low minimum, high liquidity, good returns, historically outpaced the long-term average of the S&P 500, but limited tax benefits. You're probably not going to get someone on the phone to answer your questions. In fact, if they are publicly traded, they are not allowed to share any information that isn't publicly available. So you'd have no real control or sponsorship relationship. When you step over to crowdfunding, you get some better tax benefits, slightly higher minimums, historically slightly better returns, still no control, admittedly. And depending on how it's structured, you're really investing through the platform that is then placing it with the sponsor, and that may or may not come with direct access to that sponsor. And then ultimately syndications, highest minimum investments typically, still low liquidity, higher returns, typically the best tax benefits, and you have that direct relationship to build that trust ideally on the front end and then maintain it over the long term. So those are 3 paths, but what should you be looking at here? And again, I'm going to run through these because these might get real boring for those that don't love numbers, but there tend to be, I kind of call it like the main 3 returns, especially when you're looking at the syndication world. And I've added in dividend yield because REITs, that's a slightly different calculation that you're going to be looking at, but sort of implies back to the cash on cash return. And ultimately, this whole webinar is building passive income and growing your wealth through private real estate. So what are we looking at? Internal rate of return, equity multiple, and cash on cash return. Internal rate of return, I really think of that as the trajectory of capital. It's, without getting too technical, it's not quite your annualized return, but it kind of signifies that. But the shorter the hold period, typically the better the overall return. So high IRR deals are going to be good if you're trying to cycle capital fast, get in and out, uh, kind of get your money back sooner. An 18-month hold is going to have higher IRR than a 60-month hold. Conversely, equity multiple, and I talk to a lot of investors who say, I want to double my money every 5 years. Great. Equity multiple might be the right metric for you. I don't think it's a standalone, but it kind of holds true in this instance. So in and of itself, an equity multiple doesn't take into account the hold period. It just simply adds up the distributions over the life of the investment divided by your initial investment. So if you're getting make $50,000 uh, in distributions over 5 years, you get $150,000 back from the sale. So you've gained $200,000 and you invested $100,000 initially. You've doubled your money, and that might take 5 years. But if you hold for 10 years, that might be more like a 3x hold. Um, Even if that might not be a faster trajectory of capital. Cash on cash typically is going to be looking at, when we're talking cash flow, that's going to be one of your bigger drivers and metrics. Uh, and it tends to be displayed in an annual basis. So if I invest $100,000 and I'm getting a 6% cash on cash return in the first year, for instance, uh, that'd be $6,000 distributed back to me. So it's how much I'm getting back in my bank account relative to how much or back in my bank account over a period of time, uh, divided by how much I invested initially. So if you're really trying to drive income, consistent income, that cash on cash is a big piece that you should be looking at. Um, Alternatively, to compare back to IRR takes in both the cash flow and the appreciation side. Only once the appreciation has actually been put in your bank account. So those would be the three. And for me personally, I kind of balance all three together. When I'm investing in deals that are called value add deals, I want some cash flow. So I want a cash on cash return, but I also want some appreciation. So I want a slightly higher multiple, and I'm willing to trade off a little bit of the current cash flow for more appreciation. Alternatively, if you're looking at this as I want to build a portfolio of just cash flowing assets over the long term, IRR probably won't matter that much. Your cash on cash return would be a bigger driver. And then equity multiple, again, kind of spans the two, because the longer you hold, the higher that number will go. To compare dividend yield, which is basically the current pay of a dividend. So if I'm making 25 cents a share and the property, or the per quarter, and the share price is $25, I think my math is right, that's a 1% per quarter yield, so 4% annualized yield. But you're basically just taking, the dividend rate in dollars divided by the stock price in dollars, and annualizing that accordingly if you're looking for an annualized return. So let's take those metrics and just really understand why you can't necessarily take the one metric alone. So staying on the left-hand side, you've got a multifamily deal A and a retail deal B. So the multifamily deal projections, and anytime you're getting into a deal until everything's said and done, they are projections. So they are the sponsor's best guess at what the returns will be. But you've got an 18% IRR projected over a 5-year hold period. You've got a 1.8x equity multiple and a 5% average annualized cash on cash return. So for $100,000 over that 5-year hold, you're going to make $5,000 a year each year, $25,000 in total. And then you're going to get $145,000, $155,000 back on the exit. Sounds great. The IRR is higher than compared to deal B, a 15% IRR. But now you're getting a 7% annualized cash on cash return, or average cash on cash return over a 7-year period. And that's ultimately resulting in a 2.2 equity multiple. So I'm holding it for longer. Presumably, I'm distributing over that period. So my equity multiple will be higher. My cash flow appears to be higher, but because I'm holding longer, my IRR is going to be lower. Uh, so that's one way to really, just as an example, there's no right or wrong answer. Uh, if you're looking for more cash flow, then maybe the retail deal uh, in this instance works out better. In the multifamily deal, it's a shorter hold, higher IRR. If you're trying to grow your money faster, that might be the better option. With the one thing that I have experienced firsthand is I'm always cognizant of reinvestment risk, which you can't totally quantify. But let's say you did that multifamily deal or even the retail deal, and the deal sells, you make your great IRR, you have a great equity multiple, then what? If there's not another good investment opportunity to come into, your money might sit idle for another 6 months, 9 months, 12 months. And when you're in the middle of a either good or bad market cycle, that can do some numbers on your long-term portfolio returns, i.e., selling multifamily in 2022 was a great time, early 2022 was a great time to sell. Huge valuations. But if I didn't want to pull my money out of the market and I got that cash back from a syndication investment in 2022, my only option was to either sit with it idle, if I'm going to stay in real estate, or buy into a deal that is also probably overvalued. Um, so is one better than the other? And that's more of a personal point you have to consider. When you're into the REITs versus syndications, again, just to compare some of the overall return metrics, dividend yield is going to be compared more to the cash on cash hold or the average cash on cash return. You can still typically they use average annualized return in is the more common metric in the publicly traded market that kind of compares to IRR. Um, and then of course you can back into both of those in theory uh, with the equity multiple, although typically when you're buying a stock, you're assuming it's going to appreciate, but you're not until it's all done. It's hard to project what those sale proceeds would be. Um, and of course, there's the liquid versus illiquid nature of the two to consider. So maybe this is why everybody came. Red flags, what to watch out for, and ultimately this kind of leads into what questions to ask um, when you're looking specifically into and um, crowdfunding and syndication investments. So one of my first pieces, I won't say one is first or last, but we'll just start from the top. Lack of track record. There's always going to be an emerging manager that is trying to do their first deal, and maybe you're friends with them. Um, so if I'm looking at groups that I don't know, then I want to see a track record. I'm not looking to place venture capital, especially in real estate. So, I want someone with a track record. Now, alternatively, I have invested in a new group uh, that the company was new, but all the executives were 15 to 20-year veterans in their specific real estate space. So while the company doesn't have a track record per se, the executives certainly do. So there is always that caveat that you should be looking out for, especially if somebody's new to syndication or even if they're seasoned. I always recommend that they keep looking around for more. It's it's easy. I shouldn't say it's easy anymore, but a lot of us get comfortable. We do a few deals when we first get into the space. We get with a sponsor who goes full cycle in a couple deals, and they start, and we're like, well, they're outperforming the rest. I'm just going to keep kind of concentrating my money with them, which is great until they don't do well. And again, that them not doing well might be market cycle driven more than the operator themselves, but you want to kind of always keep some diversification in that. But to this point, it's also understanding what the market is projecting. Much like if you're getting a bid for some work on your house, you're typically going to meet with at least three contractors. You're probably going to throw out the low bid because they're not very professional. You're not sure they're actually going to execute. You're going to throw out the high bid because they cost too much and you end up in the middle of the road. So when I'm seeing groups, as it mentions, that are projecting 20, 25, 30% IRRs, which I do sometimes get those emails, I it feels too far out of market for what is typically a very safe, consistent investment when structured correctly in real estate. Alternatively, I wouldn't want to invest in a group that's only projecting a 5% IRR because I can get better than that in a money market right now. Um, Transparency issues. So, especially as you're getting in with a new group, you won't always be able to see how they're going to report because you haven't lived it, but you can certainly ask for that. You can ask for referrals. You can ask for, what are their quarterly reports or monthly reports, whatever those are, what do they look like? Um, because ultimately this is all managing this whole business working in it is managing expectations. Ideally everybody wants to under promise and over deliver, but I've talked with groups who have under delivered to investors but been very transparent throughout the whole process, and the investors are still happy, even though the returns aren't as great as they thought they would be. So really understanding that and trying to dive deeper into that. For due diligence, this can be the operator side, which is a lot of what I'm doing here. I've heard of groups where the the subscription agreement investor sign doesn't match the entity that's issuing the K1. That feels like a red flag. Now, that investor couldn't have known that ahead of time, presumably. Um, but it really comes down to, is the investor, the sponsor that you're investing with, kind of checking all the boxes? Are they doing things in a compliant way? Can you pull up their Form D with the SEC, which is their exempt offering if you're in syndications? Can are there typos in their subscription agreement? But then also diving in to, why are they investing in that asset class? Specifically, if you're looking at a diversified group, at Blackgate, we only do retail. It's what we know. It's why we invest in it because we live it day in and day out. Uh, but if you're investing with someone that's doing a little more diversified group or can shift, why are they moving from one asset class to another? How are they seasoned enough to be reliable stewards of your capital? Misaligned fees. This is one that I feel very strongly about. Acquisition fees are par for the course. I'd say I have 2 to 3%. That probably is the most common range. Um, but where I ultimately look at that is not just the fee amount, but also relative to the co-investment of the sponsor. So if somebody is investing, I know sponsors that invest $1 million into their deals. Great. They're probably the largest investor in that deal, but they also charge a 4% acquisition fee on a 50 to $70 million deal. So they invest $1 million and then they immediately turn around and collect a check for $2 to $3 million. To me, that's not an alignment. They are no longer invested in that deal. They have no long-term skin in the game. They made a significant amount of money on the front end just to buy the deal. Asset management fees, 1 to 2%. When you start getting outside of those, there should be a very good reason as to why. Um, and there are groups that have no fees. They simply, collect their carried interest. Um, so it's really just understanding that and making sure it's aligning with your goals. One thing I will note, since it came up years ago, but you can't just add up the fees. A 2% acquisition fees on the purchase price, a 1% asset management fee might be on revenue, or it might be on the equity invested. In this case, the company I worked for had a 10% construction management fee, kind of standard fare for that type of service, and they were internally managed. And I had an investor say, "Well, you're charging an 18% fee load." And I'm like, "Well, A, we're not. B, you can't just add these up and then compare us to someone who isn't vertically integrated, because they're probably paying 15% construction management. You just don't see it because it's not an affiliated fee." And then no skin in the game, which I just hit on with the acquisitions fee relative to investment. Every sponsor, in my opinion, should co-invest in their deals. Every seasoned sponsor that's gone full cycle on some deals, in my opinion, should be in their deal with real equity net of any acquisition fee they collect. I give a slight buy to earlier stage investment groups because you do need money to run a company and get up and running. Um, and it just shows how much they're really in the deal versus just trying to transact for volume and ultimately become brokers trying to collect their fees. So what's the best path forward, and kind of summarizing all of this? There's and it says the bottom, there's no single best. If you have $100 to invest, which the people that I know here certainly don't, maybe REITs are the best option. My love REITs, have them. My and this gets into general financial advice. I'm always concerned when if you're buying a bunch of mutual funds through a retirement account, how much exposure they have relative to your personal brokerage account, and kind of understanding what's in your overall portfolio, because those can be easy to overweight something because you don't think of owning Pico stock, you think of owning this mutual fund that also owns Pico stock, and then you own it as well. So you kind of double weight yourself. Um, and then there's the balanced approach. You can move into crowdfunding if you're wanting more private stuff as you have more money to invest. And ultimately, the place that I put my own capital primarily is into the syndication world, where I can lock it up for 5 to 7 years. I can pass off the control and focus on what I want to do, both in my career and family life, and kind of let the management happen over there. And obviously, these are just some generic pie charts: overweight the REITs, underweight the syndications, et cetera, if you're looking for a more balanced approach. So with that, I'll kind of outline the next steps here. Uh, but I will be sending out a recording and the presentation for your review, so you have it if you want to dive into anything deeper. Oh, I forgot to hit save here. Today is December 17th, but our next one is January 21st, which is a Wednesday at noon for our next webinar. So disregard this. I will update it before I send it out to people. But January 21st is the next webinar, first one of the year, and reach out to me directly, or I know what I covered kind of straddles the investment advice and the tax advice, which I'm not giving either of those. I'm giving education, to be clear. But if you have one of those advisors, definitely reach out to them with any specific questions that this may have brought to your attention and how it would relate to your portfolio. And with that, I'll give it a couple minutes here or I'll give it a little time if anybody has any questions, as there are a couple rolling in here. I'll let them kind of queue. So the first one I'm seeing here is what's the minimum I should invest to properly diversify? Now, this takes a lot of different approaches. Again, I don't know your portfolio. This is not advice. This is more regurgitating what I've seen. If you look at kind of the Harvard approach, the endowment approach, oftentimes there's about a 20% allocation of the total investable assets into real estate. Where it can differ is for a lot of individuals, you already have a decent amount with your home equity. A house is most families' largest single, source, largest asset and source of wealth. So you need to balance that and find what's appropriate for you. Again, if I think investable assets, I'm thinking, what I commonly read is about 20% into alternatives, real estate type stuff. And then from there, you can break it down accordingly. For me personally, I don't put any more than 10% of my real estate money into any single passive investment. So when I'm doing syndications primarily, I am taking, 1/10 of my real estate bucket to put into that, is how I diversify within that existing real estate bucket. Um, let's So on the return side, why do syndications tend to show higher returns than REITs? I will say they are a little more volatile, admittedly. So not in the day-to-day volatility, but because they are leveraged, if you're in, and it's easy to say this in this current market cycle, but if you buy closer to a peak and then you ride it down into a trough, they are going to potentially, lose money. So there is some what I call slightly higher risk there. Obviously, there's the groups that have no real experience or very limited experience, which creates a more risky environment. There's higher leverage, which creates risky environment. Um, but I think there are a lot of groups that do very well structured deals to create good, stable, consistent returns from their syndication world. And I don't have there's no, as I know of, database of the entire world of what is a syndication, those overall returns. So I'm speaking more the broad group that I have seen and different data sources that I have found where people are reporting that kind of stuff. Um, Again, kind of sitting on the syndication world, what happens if I need my money back early? This can be a case by case basis, but most syndications are we'll do our best effort to either buy you out as the GP, the general partner, or connect you with other limited partners that we know that are looking to buy positions, but there's never any guarantee. Read your subscription agreements. Some might have more liquidity options than that, but the typical is once you're in for the life of it, and can't get money back out. And I've got one more here currently. How do I find quality syndication sponsors? Well, attend their webinars would be the first one. It really is just hearing and listening, and in my opinion, sitting on the sidelines for a little bit, just watching. There are some public forums out there. There's a group called was it passivepockets.com. There's a group out there called the 506C Investor Group or Club, something like that. Uh, you probably have friends who have done this who might have some recommendations. You can look online. Um, but they are out there. The ones that tend to focus with more what I would consider lower minimums tend to be more public. Some actually will advertise specifically. You'll get Instagram and Facebook ads. Others you'll hear them on different real estate podcasts, etc. But then there are a lot of groups that are just kind of you got to be in the know. So it's just networking and talking to people and within your own network as to like what their investments look like um, and that kind of stuff. Because there are groups out there, as I mentioned, that have 250, 500,000, $1 million minimums that in my network is not an approachable minimum. So I kind of don't need to know about those. But with that, I really appreciate everyone's time and look forward to joining you again in January. Thank you so much.